is now called to order at 5:37 p.m. Clerk, could you please call the roll?
Director Alexander.
Here.
Director Chapman, not present. Director Gill.
Here.
Okay, next, we'll move on to public comment. At this time, any members of the public will have an opportunity to address the board on any item not on the agenda. Speakers will be limited to 3 minutes. Do we have any commenters?
There are none.
Now we'll go on to the approval of the September 11th, 2025 Administration and Budget Committee meeting minutes. Do I have a motion?
Move to approve.
I second. Are there any public comments?
There are none.
Could we please call the vote?
Director Alexander.
Yes.
Director Gill.
Yes.
Okay, the vote passes unanimously. Next, we'll move on to committee business, which is a presentation of the investment update as of November 2025. That's Justina.
Good evening, directors. Justina Team, Fiscal Services Officer. And tonight we have Kara Hooks from Chandler Asset Management to provide a quarterly update to our investment portfolio. I'm actually going to hand it over to her first to provide the committee an economic and portfolio update as of September 30th, 2025. And I think I have her on the line. Yes, I do.
Yes. Thank you, Justina. I'm just confirming you all can hear me.
Yes.
Wonderful. Okay, perfect. So shifting down to the economic update slide, please. What this is, it's just 3 paragraphs essentially sharing kind of our opinions on what is going on in the markets and continued uncertainty and volatility, describe the economic landscape. So the big news right now is the government officially reopened today after the House passed the spending bill last night. The president signed it this morning. So it was 43 days long, being the longest government shutdown in history. The other item within that is just continued tariff discussions that are causing some fluctuations within the economic data we're seeing. And the Supreme Court was hearing arguments on whether or not the tariffs were deemed legal based off of the parameters that the president used to use the tariffs. So they have not made a decision yet, but all of that puts some economic data in limbo. Something else that occurred with the shutdown is we did not receive economic data. So a lot of the stuff I have for you here is slightly outdated. And that's because a lot of the information was not released throughout the shutdown. If we look at the next page for employment, you can see on the left-hand side, we have non-farm payrolls as of August, and that's coming in at 22,000 jobs, which is pretty low. That gives us a 3-month moving average of 29,000 jobs. Looking at the unemployment rate on the right-hand side, we're at 4.3% in August. Underemployment, which takes those that are marginally attached to the labor force or employed part-time for economic reasons, came in at 8.1. Just to refine this a little bit, for the state of California in August, we had an unemployment rate of 5.5, so above the national average. And Santa Clara County came in at 4.6 in August, so just slightly above the national average, but under the state average. Now, the September data should be released once it's finished being analyzed because they collected all of that before the shutdown had occurred. But there is a possibility that the October employment data may not be released because, they're asking people 8 weeks ago, the prior 4 weeks of that, were you looking for work or employed? So we'll see what they end up doing with that. We'll make interesting charts for everyone in this industry if they do not release a data point. So just some other items we're looking at. Now, another factor for employment is the next slide for JOLTS. And you can see we're at 7.227 million. This is the job openings and labor turnover survey. And essentially how the different data within here tells us that there is one job for every person, every unemployed person looking for a job. So it puts it in the hands a bit more of the employer right now versus the employee. We are at a pandemic high of over 2 jobs for every unemployed person in the middle of the pandemic, and that has come down, you can see, however, still above the historical average. Now, on the next slide, we'll look at inflation, and this has both CPI and PCE. Now, we were able to get September data for CPI, the Consumer Price Index, and that is because federal employees were called back during the shutdown. They were deemed necessary to process the September CPI. The reason why that specific CPI print is so important is because it's what Social Security uses in order to decide the cost of living adjustments for next year. And they have a legal requirement to have that completed by a certain date. So it was delayed by a week. However, they did issue it. It came in at 3% for the headline number. And then if you strip out volatile items like food and energy, it also came in at 3%. So below estimates, which shows us inflation isn't on that upward trend necessarily. Personal consumption expenditures on the right-hand side is what the Federal Reserve really looks at because it's a larger basket of goods that's reviewed. And also the items are cycled in and out of that basket based off of consumer spending habits. So if beef becomes too expensive and consumers start using chicken, that's something they take into consideration. So the headline number came in at 2.7, again, taking out volatile items like food and energy came in at 2.9% in August. And the reason why, again, we look at stripping out food and energy, it's because regardless of those prices, we're going to buy them. We may just change our habits of what exactly we're buying. So we still maintain above the Fed's 2% target. However, not too far off. Now, even though we have inflation and employment, both kind of a bit, grim in the news, the consumer is still spending, and you can see that on the next slide. We have retail sales looking at month over month came in at 0.6%, year over year 0.5% in August. But really looking at the consumer confidence there on the right-hand side, that's dipped a little lower in October at 94.6. And so we're seeing, some hesitancy still towards optimism that consumers have. We are seeing a slight increase in 90-day auto delinquencies on a year-over-year basis. What that means is that from our side, when we're purchasing any auto items, really taking into consideration the level of consumer that we're purchasing those at, and then also just the overall strength of the brand. 1 in 5 new cars have a payment of over $1,000. So definitely something that, again, is taking a bit of a ding out of the consumer spending. If we look at leading indicators on the next slide, we have the leading economic indicators coming in at negative 3.6%. And that's mainly supported by how strong the S&P has been. So really stocks. CFNAI on the right-hand side, which is the Chicago Fed National Activity Index, came in at negative 0.18 in August. And again, as long as that line stays away from negative 0.7, we look to be in the clear of a recession at that time. Regardless, what both of these are telling us is that we continue to have some below trend growth. However, not really near any previous recessionary periods that would give us an indication of a pending recession at this point. Now, the next slide, we have housing, and housing starts have dropped to 8.5% in August due to market pullback and elevated inventory along with softening labor markets. So the elevated inventory, a lot of people are putting their houses on the market. So they're sitting a little bit longer in most areas. The Freddie Mac 30-year fixed rate came in at 6.24% as of today, which is the lowest it's been in quite some time. So that may inspire some people to go back into the market that are looking to purchase a home. And also looking at the chart on the right-hand side, The S&P 20 City Composite Home Index is on a downward trend. We're at 1.6% in August. Now, again, to narrow this down for Santa Clara County home prices, they are up ever so slightly. And this is one county where homes are selling quicker this year than they did last year, with a similar amount sold this year than last year. So the county is not necessarily experiencing what most of the nation is at this point. On the next slide, we see the Institute of Supply Management. And this is really an area where we can gain some insight in employment. So although we're not necessarily getting the federal employment data, we can look elsewhere to gain insights into how the labor market is faring. And so one item with manufacturing, it came in at 49.1 in September. And 48.7 in October. Now, that slight decrease was due to some tariff uncertainty, and that number continues to be in the contracting territory. With services, which can include your finished retail goods, in September, that was at 50.0. In October, it rose to 52.6. So what they're seeing is a surge in new orders from AI data centers. And that puts them back into the expanding territory. Now, looking at GDP, so the gross domestic product on the following page, we have our third and final estimate for June 2025 at 3.8%. And really, comparing it to the prior time period, you can look at the difference between personal consumption expenditures, the gross private domestic investment, and then imports and exports, and see really how those numbers have turned. Now, specifically looking at net exports and imports, we had a surge in imports during the first quarter of this year due to people and retailers trying to get ahead of tariffs. Now we saw that flip in the next quarter due to a decrease in imports. So through it all, continued consumer spending though, even though we may be slightly pessimistic about what we're seeing out here, we continue to spend. And that's what gave us a total GDP number for June of 3.8%. Now we're anticipating the full year of 2025 to be about 1.8%, slightly lower than our estimates were at the beginning of this year, but overall still a robust number. Now, looking at the Federal Reserve on the following page, we can look at the chart on the right-hand side. The Federal Reserve, or the Federal Open Market Committee, met in October and cut rates to a range of 3.75 to 4%. Now, it wasn't a full consensus decision. There were two dissenters. Myron, who's the newest appointed governor, dissented due to wanting a larger cut of 50 basis points. And the Kansas City Fed Bank President Schmidt dissented because he wanted to leave rates at the 4 to 4.25% range. He didn't think a cut was necessary. So the Fed, or the FOMC, meets at the beginning of December, and we're all watching to see how much data is able to be published and caught up on before that meeting occurs in order for them to make an informed decision. Now, on the left-hand side, we have the balance sheet assets for the Federal Reserve, and we've been in a period of quantitative tightening. And what is going to happen as of 12/1/2015 or 2025 is they're going to stop. And so they're going to replace mortgage-backed securities, those pay downs, with T-bill purchases and start to raise that balance sheet back up slightly. During quantitative tightening, they've reduced their holdings by over $2 trillion. So it sits at about 6.6 trillion. And that's just one other way for them to use a tool in their tool belt to help monitor the money supply that's in the market. Now, what is this all doing on bond yields? We can see that on the next slide. So if we look at the chart on the right-hand side of the bond yield slide, we can see that the Treasury yield curve is returning to a normal shape. If we can advance one page. Perfect, thank you. Looking at the US Treasury yield curve, you can see the green line is the October 2025 number, and as rates have come down, so has the front end of that green line. We're still experiencing a bit of a kink there at the 2-year mark, and that's due to another cut already being priced into the prices of a 2-year Treasury. Now, with all of the cuts that have occurred so far, where you will see those impacted the most are in your short-term security holdings. So that would be in any pools or LAIF, because they are of shorter duration than your investment portfolio. They will realize this downshift in rates a bit quicker than your portfolio. On the reverse side, as rates were going up, they were nice because they realized that increase in rates quicker than your portfolio as well. And that's why it's so important to have a strategy bifurcation between your liquidity portion and your investment portion, so you can take advantage of those rate movements while also having a set strategy. Looking at the chart on the left-hand side, the 10-year has some extra spread over the 2 and 5-year, as you'd anticipate, because you're taking a bit more risk by investing that much further out. Now, how this is impacting Chandler's investments is we're looking to place securities a bit longer on the curve where possible, just to take advantage of those yields and lock them in for a bit longer. Otherwise, what we're seeing is an increase in our ability to invest in credit securities, which are corporate names. Any questions on the economic information before we shift into the account profile? Okay, hearing none. On the next page, we have the objectives, which focus on safety, liquidity, followed by return. And we do this by investing in high quality fixed income securities. Now, the following few pages is the statement of compliance, which shows that the investment policy and California government code are both implied here, showing that the portfolio remains in compliance with both of those items. If we shift down to the portfolio characteristics, thank you. Looking at the center column here, so through September 9/30, we were continuing to plan to use some funds from the investment portfolio to assist with a liquidity need in March. Now, since then, we are now able to invest out to a further date. So what that means is that we will take any of the cash portion that we had here and put it a little further out on the yield curve. Focusing on the September 30 column in the middle there, the average maturity came in at 1.75, so slightly shorter than the prior time period and the benchmark. The average modified duration also shorter than the prior time period and the benchmark, and that's where you can see how we were planning to use the liquidity portion. So the next time you see one of these reports, those will be built back up to match a bit more slightly to the benchmark. However, with this strategy, we still have an average purchase yield of 4.09 and an average market yield of 3.82. And what the market yield really tells you, looking at the prior time period and this one, is that rates have come down since June of 2025. The average quality continues to be AA+, and you're sitting at about 15.5 million in total market value in the investment portfolio. Now, on the next page, we have the sector distribution, and really, this does not change too much. We have a slight increase during this time period in treasuries because we were moving securities into shorter T-bills, again, to meet that liquidity need. We've since reinvested some of those a bit further out and into different sectors. And then on the next page, we have the issuers, which shows not only are you diversified by sectors, but also by the different industries and issuers as well. Now, you see the top one is United States, followed by agencies. and supranationals, which is important because all the supranationals that are permitted in California government code are AAA rated. So that helps with the credit quality of the portfolio. Next up, we have corporate securities, and we really focus on a split between industrials and financials in order to help balance one another in different market cycles. Then we have the quality distribution, which shows S&P, Moody's, and Fitch, and how those are split between all the different ratings. Now, though one security may not be rated by all three of them, it is rated by at least two of each of these. On the following page, we have the investment performance, and you can see we've had some modest outperformance since inception. Really, the portfolio came in at an excellent time because rates were moving up so quickly that we were able to really gain as those investments were initially placed. Looking at 3 months here, you can see modest outperformance. Again, all the way down to since inception at 215 versus 158. And then on the next page, we have the historical average purchase yield. And again, this just shows based off of when the authority first started investing that we were able to take advantage of that big jump in rates there, along with a contribution that was made into the portfolio to help increase rates to over 4% on the purchase yield. So that's the actual, money earned on the investments. And what we do expect for this so far through the year, as rates do come down, we expect this to maybe increase ever so slightly and then moderate a little bit and then begin to possibly decrease as overall rates decrease slightly, but we wouldn't expect that for some time because of the strategy for the portfolio. That's what I have prepared for you all for this presentation, but I am happy to take any questions that you may have.
Are there any questions?
Everything is pretty straightforward. So what is that meaning? Purchase yield of 932.4.09%. Can you explain a little bit that?
I'm sorry, can you repeat the question?
Okay, so purchase yield as of 9/30/25 is 4.09%. Just
Yes.
explain a little bit in detail, then I can understand properly.
Okay, so the average purchase yield is the actual money that the portfolio is earning on, a monthly or quarterly basis based off of interest payments, maturities, any potential pay downs that we have in the portfolio. So those are the funds that are coming into the portfolio that we then reinvest to help grow the portfolio as well. So you saw on the account profile page how we had a slight increase of, $150,000, $200,000. And some of that was because of interest rate movements, but also some of that is because of the interest that you earned on the securities that you were holding.
Okay, thank you.
You're welcome.
Any other questions? Are there any members of the public who would like to comment or ask a question?
There are none.
Okay. Well, this item is informational. I think
Yep.
there's no action needed. Thank you very much for a very thorough report.
And I do have additional context if the board committee wants to hear about it. So then, as Kara had mentioned, our market value as of 9/30 is at 15.5. And just to remind the ABC, we made our first tranche in late 2021. And then by December of 22, all 14 million was invested. So then we're now approaching our third year investing with Chandler. Of investing that 14 million. So we started with 14 million and it's at 15.5 now.
Let me ask one question.
Sure.
At the very beginning, when we start with the Chandler, so how much we just invested that 14 million?
So we did it in 3 tranches. We did it in, I think, 4, 4, and 6. $400, $400, and $600,000.
Okay.
But we paced it out like in several months.
Okay.
But basically it started around late 2021, and about a year later, all 14 million was invested. But yes, the total was 14 million.
So, so up to today, is it 14 million or we have had any interest or what is that?
So we have.
total,
So we have not added new money in, but we have reinvested the dividends and interest that we've earned on the securities back in. And now the market value of the portfolio is at 15.5 million.
Okay,
Mhm.
thank you.
Yep. And then as Carl had mentioned, the purchase yield is 4.09. I had looked up the county pool. They had just released their 9/30 25 data. That was at 3.92%. And then the current Fed rate is the 3.75 to 4%. So, you know, our portfolio is tracking pretty well. And exactly what Cara had mentioned, the outlook is that rates are potentially continuing to drop. And so we are utilizing a Chandler's managed portfolio to kind of lock in those rates for slightly longer durations, rather than keeping cash in our county pool, for the same reason that the county pool has shorter durations. So they react a lot more quicker to the market changes. My kind of layman's analogy to it is like Chandler's portfolio is like a CD, and then the county pool is kind of like our high yield interest account. So the thing is, regardless of the market changes, the CD promised a certain rate for a certain period of time, whereas your high yield savings, it might fluctuate. It might send you a notice and say, oh, the Fed dropped the rates. Your interest rate has now changed, kind of thing. So then we kind of analyzed our cash flow. We looked at our current balance in District 1, Measure Q, Measure T, and Reserve. And the county pool has approximately 28 million as of October 31st. And so with that healthy cash flow to fund our current approved budget, plus another fiscal year of a proposed budget that may remain fairly level, we instructed Chandler to continue to reinvest any maturing securities rather than holding on to the cash to kind of lock in those higher rates. So that was kind of where Carl was mentioning and alluding to with we had held on to the cash. Our duration was lower, but we're now going to probably spend a little bit longer.
Mhm.
So during this process, do we have any kind of maturity date?
So each security has varying different maturity dates. The strategy is that we stagger it. They don't all mature like at year 5 or year 3. Some are maturing at like 1 year, some at 2, some are a little bit longer. So it's a varied basket of goods.
So,
And the quarterly updates have the monthly statements, and they have a detailed list of all the securities that we have. And each one has their own maturity date listed.
so then we have the right to just take the money out or withdraw, or
Yes.
we can just again reinvest. We can do that, right?
Yes.
Okay.
So it's fairly liquid. It's hopefully Carl doesn't like cringe or anything like that. But again, my layman's term, very similar to stocks, right? You could hold on to it. Well, for bonds, it's a little bit more different. You hold on to it and get your money back at the full principal price. But then the thing is, you could also just sell it on the second, like there's a market for bonds, but it could be at what the market is currently pricing it. So there are potential like gain or loss to selling the bond prematurely.
Yeah, to elaborate on that, Justina, so the liquidity objective that we have is not only ensuring that the authority has an appropriate amount of cash on hand to pay bills and whatnot, but also that all the securities we purchase have robust secondary markets. And so should an event arise where you immediately need to pull 5 million out of this portfolio as quickly as possible, we can sell securities at the market rate, as Justina mentioned. So it would have either, a gain or loss based off of the market that day, but have those funds available for you the very next day. So you're not locked into anything here. This is your money. If you really needed to pull it out, we could make that happen. And the beauty of these portfolios is as the rates move, because of how we have staggered all of the maturities, That's what helps kind of keep a smooth purchase yield instead of big bumps. The three big bumps you see on here is really, so we started with the initial funding, we received more funding from the authority, and then the next bump was when we received the additional 6 million that Justina mentioned. And then a little later down in 2024, that's when we moved the liquidity need out to 2026. So then we were able to reinvest again, and that's what bumped up the purchase yield. So it's really, you know, as she mentioned, this is where you want your money that you're not necessarily going to need, so that we can really put it to work and have these, you know, opportunities to make some money for the authority instead of it just sitting in a shorter or lower earning account.
And kind of to piggyback off what Cara said, our securities that we hold are graded pretty well. They're not junk bonds. So again, that secondary market is, if we need to liquidate, someone's going to buy them. They're good bonds.
Exactly.
Yeah.
If you want to go to the credit distribution slide real quick, Justina, I think that does an excellent slide of showing just where we're at in ratings right here. Yeah. So this is the three major credit ratings, and looking at S&P, Moody's, and Fitch. You're AA in all three of those. Now, Moody's just became AA. It was mainly AAA because the US government was downgraded by Moody's, but that just puts them in alignment with the rest of the two other rating agencies here. Your investment policy does not allow you to invest in anything less than an A rating. So as Justina mentioned, these aren't just high quality, these are very high quality securities that we're purchasing for you.
And that's it for my supplemental information. But are there any additional questions that I could?
Not at this point, might be offline.
That's okay.
Lots of information, but really appreciate the explanation.
Perfect.
But-
Thank you for having me.
Yeah, thank you.
Thank you.
Okay, that's it.
Okay. Are there any more public comments or questions?
If there are any members of the public joining us via Zoom who would like to comment on this item, please raise your hand. There are none.
Okay, thank you. Okay, so I think that's it for the agenda, and so we'll adjourn the meeting at 6:10.